We've been talking about the auction system. Any thoughts on that?
Hi, good morning, Haslinda. I think Savio has covered it pretty much in detail. It's very early days, and any system, when it's introduced for the first time, typically tends to have teething trouble. And it's not that India is the only isolated case there. We've seen that when systems like these were implemented across the world, obviously, initially, there were these kind of issues. So I think it's a matter of time that we should see these getting resolved.
Do you think India is actually getting into an era of higher regulation?
Not really. If you're referring to this particular, CAS, which is closing auction system, I'd say that, whether it's NYSE or LSE or Hong Kong Stock Exchange, I think each of these have the modus operandi is very different. It's a matter of time that, as we are, expanding, the base market cap is on the rise. I think it's a matter of time that these best practices, which the globe is obviously doing, definitely step into India as well. So I don't see that as excessive regulation.
Lakshmi, I want to take you to the Indian equity market. It remains to be lackluster. In fact, foreign investors have been pulling money out. The amount this year so far exceeds all of last year already. What is the catalyst that's going to change this?
So, a couple of things. If you see that there obviously has been a lot of, I would say, valuation-related concerns compared to, say, the emerging markets or the rest of the globe. The good part, Haslinda, is that quite a bit of that is starting to abate. Are we saying that, lo and behold, this entire FPI or the foreign investor movement, which was negative, is going to hugely turn positive? Well, not really. But if you see the last 2 months, specifically the months of July and the month that we are in, I think the trend is clearly giving you a positive signal. This month alone, we're touching close to about $2 billion of net flows. Last month was close to about $3 billion. Also, if you see the valuation gap because of this underperformance of India, the valuation gap is clearly crunching. Of course, it's now closer to the long-term 10-year averages. The Q1 earnings have been absolutely fantastic. And it's not just cyclicals which have done well. It's across segments and sectors that we've seen very positive, I would say, high teens or mid-teens kind of growth. And in fact, if you see on a year-on-year basis, this is the best quarter that we've seen in the last 10 quarters, 9 to 10 quarters. So I'd say that things are evolving. Things are getting better. We're not yet there, but I think, 17-year low of FPI participation also gives a massive ownership opportunity for the foreign investors.
You talk about the valuation gap closing, but India remains the most expensive among major economies. And you also talk about earnings, providing the support. Do you see earnings eventually helping to reverse course for the Indian equity market?
It definitely looks like that, Haslinda. If you look at the upgrades versus downgrades, for every 15 upgrades that you see, there are just about 10 downgrades. So clearly the ratio is tilting in favor of incremental earnings upgrades. That's point number one. Point number two is look at, except for oil marketing companies, obviously, because crude continues to be a big joker in the pack for a country like India, across segments. And it's not just metals, which I mentioned, which is more cyclical. If you look at the auto sector, look at the passenger vehicle demand, look at the commercial vehicle demand, look at the financial services where there has been asset quality, which has been intact. There has been credit growth. There has been a top line growth. So I think it is clearly visible that there is an en masse general uptick in the earnings momentum, and that could likely flow in through probably the next year, which is FY 2028. I think the key for investors to note will be, especially the foreign investors, are they going to be sustained upgrades? Till such time we don't see that, I think some bit of this is going to be more sentimental. And I must also bring in, the activity in the primary market. I think that also has started seeing some renewed momentum. I think all of that kind of acts as a strong catalyst for foreigners to take note of India.
I want to take a look at the RBI. The latest minutes at least, have been pretty hawkish. And when you take a look at the markets, it's been pretty split, on when the RBI might hike. Some say at the end of 2026, others say perhaps earlier than that. What's your own take on when the RBI might make its move?
Yeah, it did. Obviously, it was a status quo. What RBI suggested in the minutes, I think there is concern around inflation, and that inflation is emanating obviously largely from commodity prices. So it's going to be a definitely tricky situation. Our base case assumption is that we don't really see any rate action, at least this calendar year. But look at crude oil prices. As we speak, crude is already on the rise. So I think there are so many moving parts. And of course, we need to take cues from what US is going to do as far as their rate action is concerned. So I'd say base case, no rate action, but it's so evolving. The markets are definitely pricing in a rate hike end of this financial year, that is by March 2027. And obviously the bond markets are also taking in cues from that. But for now, I think markets are not overtly disturbed about a rate action for sure.
I'm just wondering how you're assessing the surging yields in the U.S. We've seen the play-through in the Asian markets. I mean, how, the yields in Asia have been moving in tandem with the U.S. How might this impact India's own market?
In India, if you see, there is reasonably strong appetite for government bonds, largely from Indian banks and Indian pension funds and terminal benefit funds. It's not really hinging on foreign participation, which is what the case has been for a very long time. So I think that definitely will continue for the foreseeable future is what our view is. Unless we see a fiscal slippage, which is again not our base case assumption, because that leads to more supply of government bonds. So I think we are likely to see a tight range of bond yields. Maybe we could edge towards the 7% mark if US yields were to continue its upward march. So I think we're looking at a tight groove of maybe lower end of 6.75, 6.8 to upper end of 7%. But it's clearly going to be a very tight groove because we have clear demand levers in the domestic market, which is supporting the momentum.
Before we let you go, Lakshmi, just a question on the rupee. What could be the next pressure point for the Indian rupee?
Well, so far, I think we've shored up our foreign exchange reserves by close to about $40 billion. That's given a reasonable, stable bias to the rupee. But I bring in crude oil over here. We are edging upward. Unfortunately, we can't do anything about it as a nation. And I think that clearly means that dollar rupee at this point in time, can be on a slightly sticky wicket. But I must also mention that the dollar is weakening. And given that, we've seen $40 trillion in terms of the debt. So I think given that sort of a scenario, I'd say that we are probably looking at a slightly more stable currency, given that the forex is more comfortable, but we can't be complacent.